The basic accounting equation is the key equation behind the entire accounting subject. Did I mention it is key? Yes, I did. If you truly understand this simple, yet often misunderstood equation, you will be ahead of most accounting students. I really mean it. You see, everything in accounting, and I mean everything you need to learn in accounting and finance as a subject from the basic to master level, revolves around this equation. If you get this concept, the rest of the entire accounting subject will become much easier for you. And in order to fully understand this key equation, we will be taking a detailed look at each of its three components, which are each covered in their own tutorials. The whole of accounting is based on one single equation: assets equals owner's equity plus liabilities. By learning what each of these terms mean, and how they add up to the equation, you'll be in a perfect position to go through more complicated parts of the subject. The word equation comes from the word equal. For any equation, one side always equals another. Also, equations can actually be made out of anything. For example, 1 orange equals $0, 50 house equals walls plus doors plus windows plus roof, 1 week equals 7 days. Have you heard of the basic accounting equation or accounting formula? Do you know what it is? It's the fundamental equation that underpins all of accounting. In other words, it's really important. Why is it so important? Because all accounting entries, I mean all of them, are derived from it. Let me say that again, all accounting entries. All of them. So, if you really understand this equation, the rest of accounting becomes that much easier. If you don't understand it, you'll probably find the subject very hard. So, what does the basic accounting equation or basic accounting formula mean? Well, in order to answer that question, we need to look at what each of the terms in the equation means. 1. Assets. Assets are basically possessions of the business. They are things that add value to the business and will bring future benefits in some form. Examples of assets include cash and cash equivalents. The example: savings accounts, petty cash, accounts receivable, money owed to the business by customers, inventory, goods or products held for sale, property, plant, and equipment. Example: land, buildings, machinery, and investments. Example: stocks, bonds. 2. Owner's equity, or equity. Owner's equity, or simply, equity, is the value of the business assets that the owner can lay claim to. The owner's equity is simply the owner's share of the assets of a business. In the simplest terms, owner's equity is the value of the assets that the owner really owns. In other words, it is the amount of money that would be left over if the business were to liquidate all its assets and pay off all its liabilities. Examples of owner's equity include capital contributions, money invested by the owner or owners, retained earnings, profits earned by the business that are reinvested or held for future use, dividends paid, money distributed to the owner or owners as a return on their investment. 3. Liabilities. Liabilities are basically debts. The amount of liabilities represents the value of the business assets that are owed to others. It is the value of the assets that people outside the business can lay claim to. Examples of liabilities include accounts payable, money owed by the business to suppliers, loans and other debts. Example: mortgages, bank loans, lines of credit, unearned revenue, money received from customers for goods or services not yet delivered, and accrued expenses. Salaries or wages owed to employees for work performed but not yet paid for, or utilities such as electricity or gas that have been used but not yet paid, or rent owed to landlords for the use of property or equipment but not yet paid for.